Joselin, I want to buy a home, but I don't know how much we can afford. That is a great question. I get asked this so often. Let me teach you how you can do the math to determine how much it is that you can afford. When I am working with my clients, banks and lenders have to use a debt-to-income ratio to determine how much it is that you can afford to pay each month and which loan programs you qualify for. How do we calculate your debt-to-income ratio? Let's do the math. I am going to give you two examples, Family A and Family B. Family A makes a combined household income of $69,000 a year. This is a gross annual income. We'll need to divide that by 12 months to get our gross monthly income. $69,000 divided by 12 months equals $5,750 of gross monthly income. Family A makes a total of $5,750 each month. The second number that we need to determine is how much is Family A responsible for paying each month. Family A has a total of $550 in monthly liabilities. What are my monthly liabilities? Great question. Each month, your family is responsible for paying Discover credit card, Nissan auto loan, Geico auto insurance, gas, FPL, student loans, and Capital One. For the sake of determining your debt-to-income ratio, we only use the payments that are reporting on your credit report. So for this example, we will eliminate FPL, Geico auto insurance, groceries, gas, and cell phone. We will only be using Nissan auto payment of $250, a Discover loan payment for $50 a month, a student loan payment of $100 a month, and Capital One at $150 a month. You are going to use your minimum monthly payments of all liabilities that are reporting on your credit report and know what you're responsible for paying each month. To go back, Family A has a total monthly liability of $550 a month. The third number that you'll need to determine is your proposed housing payment. This is something that I do the research to calculate for my families depending on their price point. However, if you're doing the math at home, choose a number that you feel comfortable paying each month. For the sake of this example, I am going to use a total housing expense of $2,500 PITIA. What does PITIA mean? Great question. PITIA is the total housing expense that you will be responsible in this home, including principal, interest, taxes, insurance, and association. So let's do the math. For Family A, who makes a total of $69,000 a year, we divided that by 12 to get a total of $5,750 of gross monthly income, okay? They have a total of $550 in monthly liabilities. You are going to add the proposed housing payment of $2,500. So now you have a total monthly debt of $3,050 a month. You're going to divide that by the gross monthly income of $5,750. And now we have a total of 53% debt to income ratio. That's the math. Let's do the math for Family B. Family B has a total annual income of $80,000 a year. We divide $80,000 by 12 months. We have a total of $6,666 of gross monthly income for Family B. Using the same figures from our previous example, we have a total of $550 of liabilities paid each month and a proposed housing expense of $2,500 a month, totaling a total debt each month of $3,050. We take that $3,050 divided by our gross monthly income of $6,666, and we have a total of 46% debt to income ratio. Joselin, what does this mean? Let me help you understand. Family A has a total of 53% debt to income ratio. Family B has a total of 46% debt to income ratio. Family A does not qualify for a conventional loan. However, they make for a great candidate for an FHA loan. Family B qualifies for both conventional and FHA. Now remember, this example is based off of your DTI and income qualification only. Each program has their own credit score requirement, and that will play a big factor on whether you qualify for these programs or not. I hope that this helps you have a good idea of how to calculate your debt to income at home so that you can have an idea of how to begin to play with your monthly debts to bring them into a space where you feel comfortable making a mortgage payment. Remember that the higher purchase you go into, the higher your housing expense will be. The more room you will need in your liabilities or income to afford that payment. Not every household family income is the same. not every property has the same expense. So it is important that you work with a trusted and knowledgeable mortgage lender like myself to help you figure out your financial goals and what is the next best step towards attaining your real estate goal. I hope this has been helpful. Please subscribe to my YouTube channel to continue to learn more about real estate and staying home fit.